In this segment of the Continuous Disclosure 101 series, we will be discussing material change reporting. Material change reporting is one of the key principles underpinning a fair and efficient capital market, as it alerts investors to changes that may significantly impact the value of their investment. We will begin by discussing how National Instrument 51102, Continuous Disclosure Obligations, defines a material change and provide guidance on how to determine if a change meets this definition. We will then discuss what the reporting requirements are related to a material change, including what information is required to be disclosed under securities legislation and when. And finally, we'll conclude by touching on what to do in situations where a material change is confidential. As a general reminder, the videos included as part of this series are only intended to be a general introduction to each topic and are focused solely on the requirements under Alberta securities legislation. The securities exchange that issuers are listed on may have their own policies and rules regarding the timely disclosure of material information. We encourage issuers to seek legal advice with respect to their specific circumstances. In addition, the views expressed in this presentation are those of the presenter and may not represent those of the ASC, other securities regulators in Canada, or staff. In assessing if a material change report is required to be filed, we must first understand what a material change is. The Alberta Securities Act defines a material change for a non-investment fund reporting issuer as a change in the business, operations, or capital of an issuer that would reasonably be expected to have a significant effect on the market price or value of an issuer's securities, or the decision to implement such a change. So, how do you determine if a change is material? In practice, assessing whether a change constitutes a material change may require an issuer to exercise significant judgment. It may involve an assessment of a number of factors that cannot be captured in a simple bright line standard or test, as there is no uniform quantitative threshold at which a particular type of information becomes material. Context also matters. The assessment needs to be entity specific, consider the nature of the information itself, the volatility of the company's securities, and the prevailing market conditions. For example, the materiality of a particular event or piece of information may vary between companies according to their size, the nature of their operations, and many other factors, including timing. An event that is significant or major for a smaller company may not be material to a larger company. In addition, issuers should avoid taking an overly technical approach to determining materiality. We've seen that under volatile market conditions, even seemingly insignificant variances between earnings projections and actual results can have a significant impact on the share price once released. Or when an analysis looks solely at the potential impact on the net profit or loss of an issuer, it may not be comprehensive enough to determine if the market price or value of an issuer's securities would be affected by the change. An issuer should not lose sight of the forest for the trees by assessing the materiality of individual facts piecemeal. As best practice, we encourage companies to monitor the market's reaction to information that they publicly disclose. Ongoing monitoring and assessment of the market's reaction to different disclosure will help issuers make materiality judgments in the future. Moving on. This slide includes a small selection of items that we often see issuers report as material change. For example, a significant acquisition or disposition, a restatement or refiling of a continuous disclosure document, changes to the board or management, or the issuance of additional securities may constitute a material change. However, it's important to reiterate that this list is in no way intended to be exhaustive, and we refer issuers to Section 4.3 of National Policy 51201 Disclosure Standards for further examples of the types of events and information that may be material. As previously discussed, issuers must perform an entity-specific assessment to determine if the change, or probable change, is material to them. Now that an issuer has concluded that they have a material change to report, what next? When a material change occurs, issuers are required to immediately issue and file a news release authorized by an executive officer disclosing the nature and substance of the change. In addition, issuers must also file a material change report as soon as practicable and in any event within 10 days of the date on which the change occurred. It is important to clarify that the change occurs once the decision has been made to implement it. This may happen even before the directors approve it, if it is probable that they will do so. For example, if an issuer restates their financial information, the key date is when the decision is first made to restate it, not when the restated financials are filed. Although the full impact on the financial information might not yet be finalized, the fact that the issuer plans to refile or restate and the nature and substance of the change may be material information to investors. The material change form is found in National Instrument 51102 and is labeled Form 51102 F3. This form is required to be filed on SEDAR+ in each jurisdiction where the issuer is a reporting issuer. The main objective of this form is for issuers to provide a full description of the nature and substance of the material change. The disclosure provided should be sufficient such that readers can appreciate the significance of the material change without having to refer to other disclosures. Some examples of significant facts that may be disclosed include dates, parties, terms and conditions, descriptions of any assets, liabilities, or capital affected, purpose of the change, financial or dollar values, reasons for the change, and general commentary on the probable impact of the change on the issuer or on its business plan, operation, and capital requirements. In addition, in certain circumstances, additional disclosure may be required. For example, if the material change relates to a restructuring transaction and a circular or prospectus has not already been filed, the issuer is also required to include prospectus-level disclosure for the entity and each significant entity involved in the transaction. More information on the disclosure required in these instances can be found in Section 14.2 of Form 51102 F5. Or, if the material change is a related party transaction that falls within the scope of Multilateral Instrument 61101, additional disclosure is required as outlined in Section 5.2 of that instrument. Form 51102 F3 also requires issuers to include details about the initial news release that was disseminated, the name of an executive officer at the entity who is knowledgeable about the material change, as well as additional information if the report is being filed on a confidential basis or if any information has been omitted. As a general principle, it is important that disclosure remain factual and balanced and that issuers avoid including unnecessary details, exaggerated reports, or promotional commentary. When discussing the material change, issuers should also consider disclosing the time and resources required to achieve the change, as well as any barriers or obligations that they may face. To comply with the form requirements, it may not be sufficient to simply reproduce what has been included in the news release. And as always, we remind issuers that unfavorable news must be disclosed just as promptly and completely as favorable news. Finally, there may be circumstances where it would be unduly detrimental to an issuer's interest if they were to disclose a material change publicly. In these very limited circumstances, securities legislation allows issuers to delay disclosure of the material change. For example, this might be applicable if immediate disclosure might interfere with a company's pursuit of a specific objective or strategy, with ongoing negotiations, or with its ability to complete a transaction. If the harm to a company's business from disclosing the change outweighs the general benefit to the market of immediate disclosure, withholding it may be justified. In these instances, entities must still make a confidential filing with the applicable securities regulators. In Alberta, this can be done by emailing the completed form to confidential.mcr@asc.ca. This enables issuers to delay disclosure of the material change and to keep it confidential temporarily. In these instances, the issuer must ensure that the report is marked confidential and include the reasons why. The issuer is also required to advise the regulator every 10 days in writing if the report should continue to remain confidential. We discourage companies from delaying disclosure for a lengthy period of time, as it becomes less likely that confidentiality can be maintained beyond the short term. In these cases, it is also critical that the issuer maintain complete confidentiality with respect to material change until it is generally disclosed, and take steps to avoid leaks or trading on undisclosed information. The issuer should ensure that they are monitoring market activity in the company's securities for any unusual activity that may mean news of the matter has been leaked, and that certain persons are taking advantage of it. If the confidential material change or rumors about it have leaked or appear to be impacting the share price, a company should take immediate steps to ensure that a full public announcement is made. This concludes our overview of material change reporting, which forms part of the Continuous Disclosure 101 series. Other videos in this series can be found on our website. If you have any questions, please don't hesitate to reach out to the contacts listed on that page.